What happens when the math works, but the mortgage doesn't? What happens when you and your attorney and your spouse's attorney come to a divorce settlement that doesn't address future mortgage financing needs? And what can couples over 50 do well in advance of divorce to protect against future mortgage financing problems should the marriage end? To help us answer these questions, I welcome back to the podcast Tami Wollensak. Tami is a licensed mortgage loan originator and a 28 plus year veteran of the industry. Tami discovered her passion for helping divorcing individuals navigate their home equity solutions and mortgage options while going through her own divorce. Tami has earned the Certified Divorce Lending Professional designation to help guide her clients and their attorneys through the real estate financing and refinancing options as they go through divorce. And of course, Tami and I are both members of the Amicable Divorce Network. For more information on that, visit divorceamicably.com. Tami, welcome back.
Thanks so much for having me, Andrew. I was looking forward to this conversation. It's always such a good one.
Thank you very much, Tami. It's great to have you back. So, when you say the math works, but the mortgage doesn't, what are you referring to? What's the breakdown between the divorce settlement and lending reality?
Well, in a divorce situation, when there's a divorce present, everything can look really good on paper. From a division of assets standpoint, everything can be equitable and make good sense on paper. But there's so many other complexities that need to be addressed if there's a mortgage involved or if there's a piece of real estate involved that a lot of times it's not an attorney's job to understand that. Their job is to get the client through the legal process. But through that process, a lot of times people are signing up for things that they cannot necessarily carry out if they have not done their own research and made sure from a lending perspective that it makes sense. And there's a really big gap between family law and mortgage lending. And that's really become my passion to kind of fill that gap.
So you're saying there's some snags that can happen when you hit underwriting while going through divorce or emerging from divorce?
Absolutely. Big ones. Timelines that need to be met that aren't addressed. Maybe nobody took into consideration what the client's credit looked like. Maybe they haven't been in the workforce for quite some time, or they just rejoined the workforce. Maybe they just started a new opportunity for themselves and became self-employed. And maybe they're doing really well. Maybe they're bringing in a significant amount of money, but from a lending perspective, I can't count self-employed income until I have it for a certain period of time that's on a tax return. And so there's some really big hurdles that need to be looked at. And if you can take a step back and do some planning before you sign your settlement agreement so that you can make sure all of those boxes are checked, looked at, identified, and we can create solutions so that you can meet the goals that you're setting out to do. And once that, and then also the way that the language is in the settlement agreement, sometimes the way things are worded might be legally correct, but we need it maybe more specific, maybe some things broken down from a liability standpoint. Sometimes I see, spouse to pay the Wells Fargo credit card and they have three of them.
Right.
So, um, when an underwriter gets a hold of it, you have to figure the underwriter is not a legal professional. So you want to make things as clear to them also as possible, so that there aren't any hurdles to jump through post-divorce. There's nothing worse than having to go back and ask your spouse to have to sign something additionally or, clarify something. You're getting an attorney back involved because an underwriter is going to stand firm on something because they're not clear.
Tammy, what you're saying points up, and we've discussed this before, but I think it bears repeating, is that family law attorneys are experts in the law. Therapists are experts in emotional regulation. Financial experts are expert in investments and finances. You're a certified divorce lending professional. The key word there being divorce, I guess. I mean,
Yeah.
just to back to basics, how do you differ from a typical mortgage lender?
Well, that's a great question, and I'm glad you asked because a lot of mortgage professionals understand mortgage lending guidelines, but they don't know how to communicate that not only to the client, but the professionals that are surrounding them as they're going through their divorce, helping them structure things and create a settlement agreement that can be carried out post-divorce. So that's really where my role is. I fit in between the creating the settlement agreement and carrying out the mortgage lending post divorce or whatever is decided on when it comes to a marital home or maybe any other investment properties that a couple might have. And bridging that gap is really important. And a lot of mortgage professionals aren't trained to do that. And that's what I'm trained to do.
Before we get into some of the specific issues you mentioned, like timeline and credit, how long in the workforce, the language of the agreement, those type of things, people might think bringing a mortgage expert into the process is going to cost them a lot of money.
Mhm.
Um, how do you answer that concern?
That's one of my favorite questions to answer because I do not charge anything for my consultations. And the
Mm.
reason is I'm a licensed loan officer. In the event that there's mortgage financing that needs to be had, that's how I get paid is to close loans. My planning services and my guidance, I can't charge a divorcing homeowner and then not charge a first-time home buyer. I'm doing something similar as guiding people, educating, creating a plan that can be carried out with mortgage financing. So I don't charge anything for my consulting services. So it's a great fit and it's a really easy step to take to working with somebody that's trained in this area so that you're very clear and when you write up your settlement agreement, you have the confidence that it can be carried out.
Before we get into specifics, do you work with people all around the country?
I do. I'm actually personally licensed in 32 states, which is a lot of states, but
That's a
I
lot.
also have a team that is licensed in the rest of the states, so I can work anywhere in the country and we can create a plan for you. And then if there's mortgage financing necessary, then my team can pick up the ball and create the financing that's necessary.
So you mentioned a moment ago timelines. I don't get the timelines right. What do you mean by that?
So I'll give you a really common example, and that is where there was a stay-at-home parent, and that person was not in the workforce. They were, taking care of the children, doing those things, and maybe post-divorce, they're going to be receiving child support or spousal support. Sometimes it's called alimony, sometimes it's called maintenance post-divorce. And the settlement agreement says that they're going to keep the house, they're going to buy out their spouse, and they're going to complete this transaction within 90 days of the judgment, right? Very common language. I think
Hmm.
it's cut and paste language from
Yeah,
what
you
I
see it
can
so
tell.
much.
But anyways, when you have spousal support or child support that's necessary for qualified income in a mortgage, I need to receive that support for 6 months before I can use it as qualified income. So if I have a settlement agreement that says you have to carry something out within 90 days, I don't have the amount of months necessary to document the file for an underwriter to be comfortable using. It's not only just comfort, it's a strict guideline that needs to be had, that we need to see the support for at least 6 months. Now, there's programs out there that you can do it before you have the 6 months, but they're going to maybe be more costly. Maybe they're not the right program for you. Maybe you're going to pay more in an interest rate. So ideally, you want to have those two things line up. I have a lot of times people will apply with me for a divorce mortgage plan, knowing that they're going to need the 6 months. We document the 6 months, they write in their settlement agreement that they're going to do the transaction within 8 months. That gives them the assurance that I can get the 6 months paid as ordered from their spouse, document all that, and then carry out the transaction once I have the sixth payment. So that's an ideal situation. You don't want to sign up for something if you're being court ordered to do a transaction before you can clearly qualify for it. And that's not common knowledge when it comes to family law attorneys.
Right.
That is not their lane to understand that or be clear on that. And so it's not really their fault that they wrote that in the agreements. It's just something that needed to be addressed. And if it was talked about prior to signing your settlement agreement and all parties were okay with another 3 months, right? You're going to get your money, but it's going to be after 6 months. Okay, great. At least I know that. I'll plan for it accordingly. The other side's not waiting on this cash to come to them, all that kind of stuff.
So let's say you've got a husband or a wife, doesn't matter. One of them is going to need to refinance or finance the purchase of a new home
Hmm.
after the divorce.
Hmm.
What's the most important thing they need to understand? You touched on establishment of income for 6 months, and I'm thinking this is probably part of your answer. But what's the most important thing that a person emerging from gray divorce needs to understand about mortgage lenders and how they evaluate risk?
That's a great question because on the flip side of that, receiving support is one thing. Wonder if you're the obligated one. Wonder if you're obligated to pay support. That also creates a liability for you, like a car loan or, like any other loan out there. From a lending perspective, I have to count that in my debt to income ratios. Maybe there's a possibility to come up with a plan. And this is done a lot in a gray divorce situation where there's a lump sum payout. It's not a monthly obligation. But if it is written as a monthly obligation, we need to look at that and see how that affects the debt to income ratios post divorce to see if it's going to hinder somebody from going out and purchasing something that they want to buy, right? From a payment perspective. Okay, you're going to be obligated to pay $3,000 a month of support. What does that do to your housing debt to income ratios? So, all that stuff can be looked at prior to so that you can go back to the negotiation table and potentially make different offers, right? So that it can be carried out in a different manner. Same pot of money, maybe in different ways.
So in the gray divorce world, people in their 50s, 60s, or even 70s, in many cases,
Hmm.
these people, as part of their financial planning, at some stage are planning on taking distributions from their IRA, 401k.
Hmm.
How do those distributions play into a mortgage lender's determination?
It's actually a great question and one that I find actually a much easier process when it comes to lending because if you're over 59 and a half, you can take distributions. I only need 1 month of the distributions. I need the advisor to set up a distribution schedule. You need to be clear that sometimes it does create a taxable event, right? Income tax. You may have to pay income tax on the amount of money that you're distributing, but I can use that as qualified income. We don't necessarily have to wait the 6 months for support, which is another strategic planning thing that I do. Like, I want to get into a house immediately. Okay, well, we're going to have to set up distributions. And once I have 1 month of distributions, you can close on a new purchase for yourself. And then you're still getting the support income and all that kind of stuff. And then you can work with your advisor on what strategically is best for you and your financial future. This
Well,
is for mortgage qualifying. I'm
right,
setting it up so that they can carry out a loan, not, looking at the entire picture, which is what you would do, Andrew, right? With looking at their future
right,
financial
right,
picture.
right. And of course, it's a balancing act in the person's finances, whether if they need that distribution to show income for a lender,
Yeah,
what effect is that going to have on their taxation? And um, I mean, it is when you're taking money from an IRA or 401k, unless it's a
sure.
Roth, you're going to be dealing with taxation. And I think the
Right.
reason you mentioned age 59 and a half is that's when people can access the funds without the 10% early withdrawal penalty.
That's exactly right. Right. Right.
You
And from a
mentioned,
lending perspective, we need the funds to be 100% accessible, which if they're under 59 and a half, they are not considered accessible.
okay. I don't know if you've ever dealt with the 72T distributions. That maybe we're getting into like the detailed accounting, but that's a way of taking money out of your IRA earlier
Hmm.
and where it is accessible without a
Right.
10% penalty.
As long as we can show that, because I believe in a 72T, don't the distributions you have to take it under a 5 year
Yes.
amortization and have enough funds to do that and all that.
Yes. Yes.
Right. Yeah.
But that could potentially be worked.
Absolutely. I think us working together, Andrew, a lot of times an advisor and a mortgage lender working together strategically to, talk about all of these different options and how to get somebody into the house that they're looking to get into is key. You can't make decisions in a silo,
No, no,
right?
definitely. Are you finding it difficult for let's say someone in their 60s and what if they're retired? I mean, other than spousal support and potentially retirement distributions, um, are their options limited?
I would say they're less limited than they were before. There's lots of programs out there that can take assets and create income, right? And when I say create income, I'm not talking about distributions. I'm talking about taking a set of assets and amortizing it internally, knowing that they can make that payment. Maybe it's a 5 year amortization or a 30-year amortization, depending. Fannie Mae and Freddie Mac will let you take assets and amortize it over 360 months if you're doing a 30-year loan, and that can be considered income. It's called asset depletion,
Hmm.
right? So I'm not actually distributing the assets. I'm just saying, hey, look, they have this amount of assets. I mean, technically, they can pull from there and make their mortgage payment, right? So
Yeah.
there's a lot of creative ways, non-qualified mortgage products, meaning, it's not traditional income sources that can be used to qualify for mortgages. And I'm very fortunate that I work for a company that has a ton of different programs and options.
This is very interesting because people think they're certainly limited in the number of options they have, but there are some flexible options out there that people just don't know about. And so,
Right.
which is why, as you say, you don't get paid until the mortgage is done. Why not have that conversation?
Yeah, absolutely. And we can look strategically and say, okay, this is what column A looks like. This is what column B looks like. This is what it would look like if you did column C, so that you can look at this from a really concrete perspective and say, okay, I don't like column A. I don't like column C. I think column B is my choice, right?
Right.
And how do we carry that out?
Yeah. And something we're not going to get into in this conversation, I've dealt with it in other podcasts, and I think we touched on it briefly when we first spoke a couple of years ago, is for retired people as they, get through their 60s and into their 70s, and perhaps there's a lot of equity in that house they're selling, they have another creative solution with a home equity conversion mortgage.
Absolutely. And we have a holds apartment because that type of transaction is kind of a very specialty. You really need to know all the nuances. You don't want to get in the marketplace it's called the reverse mortgage. A lot of times people consider them reverse mortgages, but if they're explained properly and they fit the client's goals and meet the client's objectives, it might be a really good fit and it might be necessary. So there's there's always a way, it just might be planning it and strategically coming up with the different options. And you might have to wait a little while, right? Sometimes people have to rent for 6 months or a year while they're creating some of these solutions or looking at some of these options for themselves. Or maybe in their settlement agreement, they're going to write that it's going to be a year process for them and making sure that their ex-spouse is okay with those timelines. It's much better to have the agreement up front on timelines and everything than to say it's going to be 90 days and then have to go back and say, guess what? I need 8 more months.
You raised an issue there. You talked about the waiting, and I'm thinking sometimes people emerging from divorce might get a nice lump sum cash settlement.
Hmm.
Now, I might presume that as a mortgage lending professional, you might lean towards the financing option. How do you balance the issue of people later in life saying, I'm just going to pay, I've got all this money from the settlement, I'm going to buy the house free and clear, when they could potentially qualify for a mortgage? Do you have any thoughts on buying free and clear or getting the financing if you do
I
qualify
think
for it?
it's I think it's important in that respect to really have a good conversation with their advisor as well, because maybe it does make sense for them not to have a mortgage, but maybe they just aren't clear about the steps that need to be taken in order to have a mortgage. And having a mortgage allows for them to have preserved their assets, right? And a lot of times, a preservation of those assets and not putting it all into a piece of real estate. The moment you put all of your money into a piece of real estate is the moment you don't have access to money anymore,
Right.
right? You don't have, it's not like you can go put ATM card in the side of your house and pull out some
Yes.
cash and, right? So somebody strategically like you, Andrew, would be able to look at that and say, look, you're going to need access to some cash. Maybe we do a small mortgage and then pay down some of your mortgage. Maybe we do a shorter term so that you're going to pay it off faster. There's so many,
Right.
it's like a snowflake, right?
Right.
Every situation is going to be different, and we need to look at that and not make blanket observations or, comments on it because everybody's situation, sometimes they just don't want to deal with a mortgage at all, and sometimes they're just not educated about what it means to have that.
Yeah. Yeah. No, it's a very good piece of advice there, Tammy. Um, you know, we're talking about gray divorcees. You talk about couples having a backup plan conversation, or that sometimes people avoid, and why it
Yeah.
matters for people after 50. What do you mean by a backup plan
Well,
discussion?
over the last 5 years since COVID and everybody had these amazing interest rates on their mortgage, they're doing everything possible to twist themselves into a pretzel to keep that loan. We calling it, the golden handcuffs, right, Andrew?
Married to
Like
the
they're
mortgage.
married to the mortgage. Like, I'll do anything, I'll give up anything to keep my mortgage. And it's it's kind of baffling to me when I see, somebody has a $200,000 mortgage and they're willing to give up $500,000 in equity or in retirement to cover the equity that they owe out, or whatever it is. Sometimes it just doesn't make sense from a financial perspective, but their focus is keeping a 2% mortgage.
Right.
So, we've talked about this, I think, previously, that the term in the mortgage world is called mortgage assumption. That is how you can qualify to keep your current mortgage terms. You can keep the rate, the payment, everything stays the same, and you're releasing your spouse from the liability of the loan. Okay. First of all, not all lenders do this.
Right.
It's, if you got a 50-50 shot, it's like kind of the wild, wild west. They're not going to do any planning for you. They're not going to look and see if you qualify. They're going to tell you, once you're divorced, bring us your settlement agreement. You can start the process and we'll let you know if you qualify.
Hmm.
Well, I
Hmm.
have to do so much. I have to know so much.
Yeah.
But people don't care. They'll just write it in their settlement agreement. I'm going to keep the mortgage. I'm going to keep the house. And this is what I'm going to do. And then only to find out that the plan B in their settlement was assume the mortgage or sell within 6 months, let's say. Well, what if the lender allows for the assumption, is going to process the assumption? These big banks take 6 to 8 months sometimes
Wow.
to process these assumptions. What if in month 6 you get denied for whatever reason because their guidelines are more stringent? Whatever the situation, maybe the servicing got sold to somebody else, you had to start over. All these things I've heard happen. And then your only thing is the 6 month mark has come, the assumption is not done, and your backup plan was to sell.
Yeah. You got to
It's
sell.
heartbreaking, you
Yeah.
know?
So with the assumption, what if you're going through a divorce process that's amicable? Maybe it's amicable
Yeah.
network, maybe it's mediation, but
Yeah.
it's relatively quick. And should this conversation be had years? I mean, can you have this conversation years prior to the divorce? Because then it's a touchy subject.
Well, you can call your lender and find out, number one, do they do an assumption,
Right.
right? Number two, is your particular loan assumable? What's the timeline that they're taking to do the assumption? What's the cost? People don't realize they have to come to the closing table with money,
Hmm.
right? Sometimes they're not prepared. It could be thousands of dollars. They're not prepared to write checks. So having all of that information up front and then putting a plan B into your settlement agreement is what I always recommend. Okay, I'm going to assume the mortgage within 8 months. If that doesn't work out, I'm going to apply for it as soon as judgment, right? You can, as soon as you have your settlement agreement, you can apply. And if at the 6 month mark it's not done, I will apply for the refinance and I will be prepared to refinance the loan, right? Rather than sell. If you're really tied to the home and you really want to keep it, look at what all of your options mean. Maybe assumption is your preference, but if it meant between refinancing or selling, maybe refinancing is going to be okay.
Right. I mean, the bottom line here seems to be get educated and prepare well in advance, or as far in advance as possible,
Yeah,
to
and I have
understand what your options.
conversations with both spouses a lot, right? I have because a lot of times their goal is to keep one person in the home because of the kids. What does that mean? As long as you understand what you're signing up for, the right answer is what's right for you and your family, right?
Right. Right. You mentioned a minute ago, as we were talking about timelines and credit, you mentioned two other things, and this might be germane to not only gray divorce, any type of divorce where one of the spouses and typically the female is re-entering the workforce.
Mm-hmm.
You mentioned how long the lender is going to want to know how long they've been in the workforce.
Mm-hmm.
Are there any particular rules of thumb there for somebody re-entering the workforce?
It depends on their career path. Let's say they were a nurse and they previously were a nurse before they raised their children, right? Maybe it was 10 years ago, but I was a nurse and then I, decided to stay at home and raise my children and I'm going to go back to work and be a nurse. Well, if you go back to school or back to work and you're a nurse and you get a salaried position, I can use that income right away as long as it's stable and consistent, right? I'm going to tie your history back to when I need a 2-year employment history, but you used to do it, right? So I can look at that and let the underwriter know they did this before. They're trained to do this, this career path, and now they're doing it again and they're employed. I can use that income pretty much right away. Let's say that you were a nurse, but now you're going to go into being an administrator, right? And you have variable income and you're going to kind of work when you want to work and you're going to be hourly and set your own hours. Maybe you're going to work 20 hours one week, 30 hours the next. I'm going to need a 2-year history of that because I can't show stability and consistency there because there's no way to average it until you have a history of that. I'm going to need a 2-year history when it comes to that. So there's a lot of variances to that question. And another reason that we should talk through things, because sometimes you're like, oh, I should go look for a salary job, maybe do that for a year or something, and then go do my passion project later, or something like that to stabilize themselves.
What about if you're starting a business?
If you're starting a business, then it's going to be a 2-year history. I
Yeah.
want 2 years of reportable income on a tax return.
Yeah. Yeah, that makes sense. It makes sense. Um, Tam, this is all very helpful information. Um, Anything else you want to add before we wrap up?
I think just I think the overarching theme here is planning. You can't plan too early. You can't, have too much knowledge. I know it's a very overwhelming time for a lot of people, and they sometimes just more information is like information overload. But I feel that empowering yourself to make these decisions for you and your financial future is really critical. And you and I both understand what they're going through and try to come at it from a very empathetic place. It's not a pressure place. It's a very calm conversation about what does your future look like? What are you trying to sign up for? And does it make the most sense for you and your financial future? There's nothing worse than signing up for something post divorce and being stressed by a financial decision that you made before you signed your settlement agreement.
Yeah, no, exactly. Great advice, Tammy. If any of our listeners would like to learn more, chat with you, how can they reach you?
So my website is takeorleavethehouse.com, and there is an open calendar on there. You can jump on and grab 15-minute consultation with me. In 15 minutes, we can cover a lot of ground and then we can decide what the best path for you is from there. So I always like to direct people there, and that way we can have a one-on-one conversation.
Takeorleavethehouse.com.
Yep.
Very catchy.
Well, it's actually TamiWollensak.com as well. You can always put that in too, but it directs you to they call it a vanity URL. I just thought exactly, how does somebody going to remember TamiWollensak.com? They're not.
It might be a little tricky for people to spell, but they can see in the
Right.
show notes the proper spelling of your name as well.
Yeah, either one gets you there.
Terrific, Tammy. Thank you very much for your time.
Thanks so much for having me, Andrew.
Thanks so much for tuning in to this episode of the Gray Divorce Podcast. To learn more or get in contact with your host, you can visit Andrew's website at transcendretirement.net. Also, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. That helps others find the show, and we greatly appreciate it. Thanks again for listening, and we'll catch you in the next episode.
Information provided is educational only and should not be construed as legal or tax advice. Each situation is unique and should be discussed with your tax or legal advisor prior to implementation. Andrew Hatherley is not an attorney and does not provide legal advice. Information provided is financial in nature. Advisory services offered through Hatherley Capital Management, LLC. Divorce financial analysis services offered through Wiser Divorce Solutions, an affiliated company.